Imagine you've done everything right. You bought your home 30 years ago. You raised your family there. You maintained it, improved it, loved it. And now the kids are gone. The house feels too big, and every financial advisor you've talked to says the same thing. Downsize. It's the smart move. So you do it. You sell a $700,000 home and buy something smaller for $400,000. You pocket the difference, or so you think, and you sit back feeling like you finally won at the money game. Then the tax bill arrives. And it isn't for $5,000, it isn't for $20,000, it's for $150,000 or more. And the worst part? It was completely legal, completely predictable, and almost nobody warned you. This isn't a horror story. This is a pattern that has quietly destroyed the retirement plans of hundreds of thousands of American homeowners. Today we're going to talk about the capital gains trap hidden inside home downsizing. We'll explain how a protective tax rule was warped. By the end of this video, you will know exactly why downsizing might be the single most expensive financial decision you ever make. To understand the trap, you have to understand the rule. It's 1951. America is booming. Soldiers have come home. The government wants people to buy homes. It wants them to move up, upgrade, reinvest. But there's a problem. In the early 1950s, capital gains rates were punishing. If you sold a home for profit, the government wanted a significant piece. People stopped moving. They stayed in homes that no longer fit their lives. The housing market began to freeze. Congress had to act. The first fix came in 1951, the rollover provision. If you bought a new home of equal value, you could defer the tax, but then something happened. Home values started going up. Fast. Faster than anyone in 1951 could have imagined. By the 1990s, a retired couple in California might have watched their home balloon from $80,000 to $500,000. They were millionaires on paper, but they hadn't set out to be investors. They just lived in their house and trimmed the hedges. And now they were staring at a capital gains liability of potentially $400,000, with a tax bill that could exceed $80,000 to $100,000. If they ever tried to access that wealth. The rollover provision didn't help them, because they didn't want a bigger house, they wanted to downsize. They wanted to cash out, simplify, and live modestly in retirement. Once again, Congress stepped in. In 1997, President Clinton signed the Taxpayer Relief Act, and buried inside that massive piece of legislation was a provision that would define the financial lives of American homeowners for the next 3 decades. Section 121. The rules were simple and they were generous. For 1997, if you had lived in your primary residence for at least 2 of the last 5 years, you could exclude up to $250,000 in capital gains from federal income tax. For married couples filing jointly, that exclusion doubled to $500,000. No rollover required. No need to buy another home. Just sell, pocket the profit up to those thresholds, and walk away clean. For most homeowners in 1997, that exclusion was enormous. The median home price in America at that time was around $146,000. A couple who bought their home for $100,000 and sold it for $400,000 was well within the $500,000 exclusion. The rule felt almost impossibly generous. Congress patted itself on the back. Homeowners breathed a sigh of relief. And financial advisors began telling every retiree the same thing. Don't worry about capital gains on your home, you're protected. Here's what they didn't account for. Time. The $250,000 and $500,000 exclusion limits set in 1997 have never been adjusted for inflation. Let me say that again, because it's the core of everything we're about to talk about. The exclusion limits from 1997 have never been adjusted for inflation or home price appreciation. In 1997, $500,000 covered almost every ordinary homeowner in America. Today, in 2026, the median home in cities like San Jose, San Francisco, Seattle, Denver, Austin, New York, and Miami has appreciated so dramatically that millions of ordinary middle-class homeowners, teachers, firefighters, nurses, small business owners, are sitting on homes with gains that blow straight past the exclusion. And when they downsize, they find out the hard way. Let me walk you through a real scenario, not a hypothetical billionaire. An ordinary American couple. Call them Robert and Linda. They're in their late 60s. They live in a suburb of Seattle. They bought their home in 1994 for $185,000. Over 32 years, Seattle's housing market has been one of the hottest in the country, driven by the tech boom, Amazon, and Microsoft, and a wave of high-income transplants that fundamentally transformed the region's real estate values. In 2026, their home appraises at $100,000. Their gain? $915,000. Their Section 121 exclusion? $500,000. Their taxable gain they cannot exclude? $415,000. At the federal long-term capital gains rate of 20% for higher income earners, they owe $83,000 in federal capital gains tax alone. In Washington state, there's no state income tax on capital gains above $250,000 at the state level, so they're somewhat lucky there. But in California, Oregon, Minnesota, or New York, they'd add another 9 to 13% on top. Robert and Linda didn't get rich. They got old in a neighborhood that got expensive around them. They didn't make investment decisions. They made living decisions. And now the government wants $83,000. In higher tax states, it's closer to $150,000 before they can access the equity in their home. Many homeowners don't discover this until they're already under contract, found the smaller home, and started packing. And then their accountant calls. The conversation usually goes like this. I've been running the numbers on your home sale. And then the number drops. And then silence. Because most people genuinely believe the $500,000 exclusion covered everything. Their real estate agent didn't warn them. And the rule itself, unchanged since 1997, simply wasn't designed for 2026. In 1997, the median home price was $146,000. In 2026, it has surpassed $420,000. In cities like San Jose and San Francisco, prices are up over 600%, but the tax exclusion is up 0%. The cruel irony is that it hits the people least equipped to handle it, like retired school teachers in California. We're talking about widows in New Jersey who inherited a home they've lived in for 40 years and are now punished. Scenario 1. The surviving spouse. When one spouse dies, they receive a step-up in basis only on the deceased's half. In community property states like California, both halves receive the step-up, a crucial distinction many people don't know. A widow in New York might find her effective exclusion drop to $250,000, resulting in a dwarf tax bill. Scenario 2. The home improvement trap. Capital improvements increase your cost basis, but only if you can document them. Receipts from a kitchen renovation in 2003 or a new roof in 2015. Most people throw those away. Without documentation, the IRS won't credit you for tens or hundreds of thousands of dollars in improvements that would have reduced your taxable gain. The tax bill gets bigger, and there's nothing you can do about it retroactively. Scenario 3. The partial exclusion trap. Section 121 requires you to have lived in the home as your primary residence for at least 2 of the last 5 years. If you moved to an assisted living facility, or moved in with family to recover from surgery, or rented out the home temporarily, even with every intention of returning, the clock on your exclusion eligibility may have been quietly running out. Miss that 2-year window and you lose the exclusion entirely. These are predictable outcomes of a law designed for 1997's housing market. Over the past 2 decades, there have been multiple legislative proposals to update Section 121. Inflation indexing the exclusion. Raising the limits. None of them passed. Because updating Section 121 costs money. Protecting middle-class homeowners has consistently lost out to other priorities. The result is a slow-motion catastrophe. Every year that limits stay flat while values rise, another wave of homeowners crosses the threshold. In 2026, the situation is worse. The interest rate hikes between 2022 and 2024 suppressed volume. Many who would have downsized waited. Baby boomers, the largest homeowning generation, are now entering the prime downsizing window. This cohort bought homes in the 70s and 80s, A boomer who bought in suburban Boston in 1982 for $120,000 may be sitting on a home worth $900,000 today. Their taxable gain above the exclusion could be $280,000 or more. That's a tax bill of $56,000 to $84,000. Meanwhile, the financial advice ecosystem hasn't caught up. Many planners still believe home equity is a clean, tax-free asset. For most of their careers, it was. But in 2026, the tax trap is real and waiting for the unprepared. In 2026, that model is dangerously outdated. The second pattern worth watching: estate planning overlap. Many homeowners are now weighing the decision between downsizing now and holding the home until death, at which point heirs receive a full step-up in cost basis, wiping out the capital gains liability entirely. This is a legitimate strategy, but it's not without its own complications. Estate tax thresholds, the ability to maintain the home, and the carrying costs of holding a large property for years longer than you need it. The point is that these decisions are no longer simple, and the financial stakes are high enough that making them without expert guidance is genuinely risky. Let's bring this home. 3 things you need to know before you make any decision about your primary residence. Takeaway 1. Know your cost basis before you do anything else. Your cost basis is not just what you paid for the house. It includes every capital improvement you've ever made: kitchens, bathrooms, additions, new roofs, HVAC systems, major landscaping. Every dollar you can document in permanent improvements reduces your taxable gain. Go find those old receipts. Pull old permits from your county records office. Many municipalities have digitized these and they're publicly accessible. Talk to your accountant and reconstruct your basis as accurately as possible. This is not paperwork for paperwork's sake. This is potentially tens of thousands of dollars you are legally entitled to exclude from your gain. Takeaway 2. The $500,000 exclusion is a ceiling, not a floor, and it may not protect you at all. Stop assuming the exclusion covers your situation. Run the actual numbers. Have an honest conversation with a CPA who understands real estate taxation. Do this before you're under contract. Once you're under contract, your options narrow dramatically. The strategies available to you before a sale, installment sales, charitable trusts, timing strategies, largely disappear after closing. Takeaway 3. Downsizing is not always the right move, and the financial advice industry has been slow to update its models. There are scenarios where staying put, or holding the property until your estate receives a step-up in basis, is financially superior to downsizing today. There are scenarios where a 1031 exchange into a rental property, rather than a direct sale, preserves wealth far more effectively. The decision is not simple. It is not automatic. Anyone who tells you just downsize without running your specific numbers is giving you 1997 advice in a 2026 housing market. Here is the uncomfortable truth at the center of all of this. The capital gains trap hidden inside home downsizing is not an accident. It is the predictable result of a tax provision designed for a housing market that no longer exists, left unchanged by a Congress that has found it easier to ignore the problem than solve it. Every year it goes unfixed. More homeowners cross the threshold. More retirees discover too late that their biggest financial asset comes with a hidden tax liability that can cost more than a new car, more than a year of college, more than most people earn in a year. And the pattern repeats. The 1990s couple who barely escaped it. The 2000s couple who were protected just in time. The 2010s couple who started to get caught. And now in 2026, an entire generation of boomers walking into the most expensive financial decision of their retirement years. With models, assumptions, and advice that were built for a world that is 30 years gone. The question worth sitting with, the one I want you to take away from this video, is this: if a tax rule this consequential hasn't been fixed in nearly 30 years, what does that tell you about how much the system protects you? And what are you going to do about it before you sign those closing documents? If you're within 10 years of selling your primary residence, do one thing. Call a CPA, not a financial planner, a CPA. Ask them to calculate your current taxable gain on your home. Just know the number. That's it. You don't have to make any decisions today, but you cannot make a good decision without knowing what you're actually dealing with. If this video helped you, please hit the like button and share it. This information doesn't reach people until after the damage is done. If you want to understand specific strategies for reducing capital gains, subscribe and you'll be the first to know when that video drops. I'll see you in the next one.